Hello, everyone. Welcome to another episode of the Doctor's Eyes Only podcast. I'm Lauren Oshman, and today we are going to talk about the limitations and flexibility in 529 college savings plans. Thank you so much to those of you who have followed the show, who are downloading episodes, who have left us reviews. That really does mean a lot to us. We've been really working on bringing you more of the content that you all have been asking for. If you are listening and liking what you hear, please do share, like, subscribe, leave us reviews. You can also find us on YouTube, Facebook, LinkedIn, and we're new to Instagram. So whatever platform you like to consume your content, head over there, follow us at Vestia Advisors, and we will have more great content coming your way soon. So I thought this would be a good topic to cover today because I have found myself not just with newer physician clients, but also clients that I've worked with now for 10 to 15 years, where we've had to kind of go back and talk about what are the cases that are qualified uses of $529, and then how those dollars can actually be used with more flexibility today than the rules allowed for them to be, say, a decade ago or more when a lot of these physicians initially set up these plans. I'll start from the beginning. What is a 529 plan? A 529 plan is specifically for college saving. Well, I shouldn't say college savings. 529 plans now are specifically for education savings. It was true a while back that they were specifically for college, but I'll talk about in a minute that the use cases have expanded a little bit. And so now you actually can use $529 for some pre-college education expenses in certain cases. Each state operates a 529 plan. So I live in Tennessee. Tennessee has a 529 plan, where whatever state you live in probably has a 529 plan. You don't actually have to use your state's 529 plan. However, a lot of people choose to do so because a lot of states will offer a state tax deduction for a certain amount of contributions into that particular state's 529 plan. Great example. I was talking with a physician who lives in Ohio yesterday, and in Ohio, they offer an Ohio tax deduction. So I think Ohio state tax rate is around 4%, maybe a hair under that. You actually save Ohio state taxes on up to $4,000 per year per kid of contributions into a 529 plan. They only offer that to you if you use the Ohio state plan. So for that physician who's in Ohio, who's saving for college for 4 kids, it makes sense for them to consider using the 529 plan that's offered by the state of Ohio. Contrast that with a lot of my physician clients that live in Tennessee, where I am, where we don't have state income tax. So even though Tennessee has a 529 plan offering, there's not a benefit to me or to a lot of my clients to actually putting money into the Tennessee 529 plan over any other plan. So we can actually go to kind of the market, look at all of the state 529 plans that are available, and choose to use the one that we feel like has the best investment setup, reasonable fees, that sort of thing. I actually personally use my 529, which is through the state of Utah. And I know that's consistently ranked as one of the top 529 plans for those who don't live in Utah, but are looking for a good plan to use when their state's plan maybe doesn't have an advantage for them. 529 plan is something that a lot of physicians will consider using for saving specifically for education expenses for their kids. Years ago, it used to be that 529 plans were for college or post-high school education expenses, meaning you put the money into the 529 plan. One of the benefits, even if you don't get a state tax deduction for your contributions, the earnings in the 529 plan, so you invest the money, it can grow based on the investments that you choose. That growth is tax-free as long as you use the funds for education. And again, it used to be that was college, grad school, that sort of thing. So a lot of people would use 529s to save for college. So contribution limits to a 529 plan, which I often get asked about, are based on what's called the gift tax limits. So right now the IRS will let any one person give any other person $17,000 before they ask for any tax reporting. And you can actually double that if there's 2 parents contributing to a 529 plan for a child. So you can put quite a bit of money into a 529 plan each year if you want. And part of the financial planning process is to figure out what you might want to be able to pay for your kids for college, and that you can kind of work your way backwards into how much money it makes sense to put away into the 529 plan in order to have that desired outcome or be in a decent position for that down the line. So your kid gets to college, you can actually use those $529 to pay for their tuition and then other qualified expenses. So this includes room and board, books, they need a computer, things like that, the costs associated with their education. So a lot of doctors who have had 529 plans for a while are very familiar with the risk of oversaving into a 529. And the reason we had to think about that is because if your kid gets through college, maybe they're not planning on going to graduate school, and you still have money in the 529, in order to use those dollars for a non-education expense, you'd have to pay taxes on all of the earnings plus a 10% penalty in order to get the money out and use it for something else. So years ago, I had a client, he had leftover $529 from his daughter. She had gone to 4 years of undergrad, wasn't planning on going to graduate school. He had plenty of money in the 529 to pay for his other child's tuition for college. And so he had this leftover money in her 529. When it came time for her wedding, we talked about the fact that those $529 were there. It probably wasn't ideal to be subject to that 10% penalty to use those funds for a wedding. But he was like, I set that money aside for her. If, hindsight, I probably would have used a different vehicle for it, so I wouldn't have had to pay the penalty, but I'm okay with it. I'm going to pay the penalty. I'm just going to give her that as the budget for her wedding. And that's what he decided to do. Over the last few years, there have actually been new provisions added to the rules around 529 plans that allow for more flexibility in how those funds are used. The first one came about with the Tax Cuts and Jobs Act back in 2017. And this allows for up to $10,000 per year from a 529 to be used for private K through 12 expenses. So I have clients who either maybe grandparents have put money into a 529 for a grandchild, and that's above and beyond what the parents already had put aside to save for college. Maybe there was an inheritance that a child received and some of that was put into a 529. Or maybe the parents, we've just kind of determined were at risk of oversaving and are paying for private K through 12. You can use up to $10,000 per year, no penalties, tax-free withdrawals in order to pay for that private K through 12. So that's one added layer of flexibility. A second layer that's always existed, and I've done this with many, many clients over the years, is you can actually take leftover dollars from, say, your oldest child, and you can change the beneficiary to be a younger child. Or I have some clients who will save those funds and plan to change the beneficiary to grandkids at some point down the line. So I actually personally have a little bit more money in my oldest child. I have 3 kids. I have a little bit more money in my oldest, 529, because I know that if she goes through school and doesn't use it all, I can easily roll that down to the second and even the third. It's going to be a little bit harder for me to peg what I might need for the third and then potentially share back up with the first, right? That doesn't make as much sense. So if we are going to be oversaving somewhere, we might put that toward the oldest. So you can roll money down to other family members. It does have to be a relative of the initial beneficiary. You can't just pick someone who you want to give that money to. They do have to have a relation to the initial beneficiary, but that's an option. And then the third option, which is actually something that's very new. So this came about with something called the Secure Act 2.0, which was passed at the end of 2022, allows for up to $35,000 of leftover 529 funds to be rolled over into a Roth IRA for the beneficiary. There are a lot of people that got really excited at this initial announcement. And as most new regulations that come out that relate to taxes and different account fundings, we had to wait and kind of see what the stipulations or the restrictions were going to be on this opportunity. So as we've learned more, you can use up to $35,000 of leftover 529 funds, which again, those are tax-free if used for education, and make a rollover to the tax-free Roth IRA vehicle for that child. There are some restrictions. The 529 account has to have been around for 15 years in order for you to have that option. The funds that you're rolling to the Roth IRA have to have been in the account for 5 years. And then the one that I've actually seen least reference to, or that I've seen least physicians know about if they've brought this up to me, is that you're still subject to the annual Roth IRA contribution limits. So for 2024, that's $7,000. That means that $35,000, if you qualify based on the first two rules that I mentioned, that would give you 5 years of Roth IRA contributions for that child. That does bring up an interesting planning opportunity if you're thinking about wanting to set your kids up with a little bit of a head start toward retirement. One, it gives you an opportunity if you oversaved. Maybe unknowingly, the child goes to a less expensive school than you expected, something like that. But it also allows for you to consider if you're wanting to give your kids some money to start on their own retirement, you could actually intentionally plan to oversave in that 529 to have that $35,000 available to roll over to that Roth IRA for them. So adding some of these additional provisions where we can use some of the funds for pre-college education, where we do have this opportunity to potentially roll some extra funds into a Roth IRA, just gives us a little bit more flexibility when we're looking at how much makes sense to put aside for your kids for college and how much of a risk we're at of having the right amount versus potentially having a little bit too much. What happens if my kid gets a scholarship? I think that's a really good question. And I've had a number of clients whose kids either have gotten scholarships or maybe they work at an academic hospital that offers some tuition remission for the children of employees. So if your kid gets a scholarship, you actually can reimburse yourself from their 529 plan in the amount of the scholarship. You still have to pay the taxes on the earnings, but you don't owe that 10% penalty. A lot of people don't realize that, and that does lead to some reticence to putting away money into a 529. So just know the government doesn't punish you if you put money aside into a 529 plan and then happen to have a child who gets a scholarship for their scholastic achievements, for athletics, things like that. We do have a little bit of leeway there as well. And I've done that for some clients in the past, and that has worked well. This is really just the tip of the iceberg when it comes to thinking about 529s. I was really trying to focus on some of the flexibility around 529 plans more than anything, since that's something that's changed quite a bit here over the last few years. We probably could do more episodes in the future, and we probably should, about some of the other things, like how do you figure out how much to save? Where do you prioritize 529 funding versus retirement funding, things like that. So please do take this information that you heard today and talk it over with your own advisor. If you're listening and either this is something that maybe your advisor hasn't quite gotten to the depth that you would like to be on this subject, or maybe you don't have an advisor who can help you think about these things, we at Vestia have a great team of advisors who help doctors with this and lots of other financial things and love doing it. So you can reach out to us at myteam@vestia.com. Let us know that you're interested in talking with one of our advisors, and we'll get you in touch with them to talk about savings for your children and savings for lots of your other goals. Once again, I'm Lauren Oshman, partner and CEO at Vestia Personal Wealth Advisors. Thanks so much for listening. We'll see you next time. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vestia Advisors, LLC. The content has been made available for informational and educational purposes only. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax advisor. This information is not an offer or a solicitation to buy or sell securities. Investing involves risk, including risk of loss. Before investing, you should consider the investment objectives, risks, charges, and expenses associated with investment products. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. Past performance is no guarantee of future results. Diversification and asset allocation do not ensure a profit or guarantee against loss. Consult your financial professional before making any investments. Investment advisory services offered through Vestia Personal Wealth Advisors, Vestia Retirement Plan Consultants, and Vestia Advisors, LLC. Securities offered through Osdale Financial Partners, Inc., 5187 Utica Ridge Road, Davenport, Iowa, 52807. Member, FINRA, SIPC. Vestia Personal Wealth Advisors, Vestia Retirement Plan Consultants, Vestia Advisors LLC, and Osdale Financial Partners Inc. are independently owned and operated.